Each week I try to give you two things. One is what is going on in the economy and or what is going on in the stock market or for the foreseeable future. Today I'm going to do both. I'm going to cover the economy from the standpoint of commercial real estate. What is going on and how does that affect you and the economy? And you may think, what does this have to do with me because I'm not in the commercial real estate market? Well, I will explain. Secondly, I'll give you a couple of views of the market for 2024. I think you'll find both of them interesting. Hi, I'm Ben Reppond. Welcome to my YouTube broadcast. Today is January 30th, 2024. I'm going to give you three views of commercial real estate and why this impacts us who are not commercial real estate investors or may not even have a lease in a commercial building. I'm going to begin with a piece, so kind of bear with me through each of these three because they're interesting, each from a different perspective. The first is from a perspective of a large real estate owner who owns a lot of properties in a lot of states, and he's looking at it from that perspective. He's being interviewed by Carl Quintanilla, and he talks about the issues, and his name is Patrick Carroll, and he talks about the issues. One of them is as commercial real estate renews their mortgage, they are facing higher interest rates. Well, see, when we're as a consumer, what we're focused on is our home. And so we think, okay, we have a 30-year mortgage or a 20-year mortgage or whatever we have, and the commercial buildings don't do that typically. Most of the commercial buildings, I'm talking about high-rise office buildings and malls and things of that nature, and could be in the healthcare industry like medical facilities and long-term care facilities, et cetera. All of those are considered commercial. And so when you're in the commercial space, those rates, the mortgages typically run from 5 to 10 years. 5 years, 7 years, 10 years is common. Sometimes they're a little bit less and sometimes a little bit more, depending on the needs of the owner and the risk involved. So let's just focus on the 5 to 10 year range, 5, 7, 10. What's happening right now is that mortgages that were very, very low, maybe let's just say 4%, are coming due in 2024 and 2025 for renewal, for rewriting that mortgage. And what's happening is that the mortgage rates are approximately double what they were, let's say, 5 to 7 years ago. The occupancy rates have gone down dramatically, causing the value, and of course the value of the property is based on the occupancy, and so causing the value of the property to drop in most cases, many cases, 40 to 50%. So imagine having to rewrite your home mortgage, paying twice as much interest, and the value of the property went down 50%. What does that mean? That means you have to put a lot more money into the deal to get that renewal to happen. And the third issue is that banks, because they're becoming more conservative over this issue, are now underwriting 40 to 50% of the value of the property with a loan. Let's just say it's 50. So in other words, you've got to have 50% of the value of the property with your own money in the deal. So you've got three things simultaneously working against you, and the option that owners of the properties have, and this is going to happen over the next 2 years. You'll hear this on these videos in 2024 and 2025, all the way through December 25. There is 1.5 trillion of commercial real estate coming due that is going to be renewed under this kind of environment. So the option that the owner has, they can put more money in the deal, and imagine a lot more money in the deal. Where are they going to get that money? Well, each one has to deal with that. Or they can hand the keys back to the bank and walk away without their non-recourse loans, which means they can walk away without the rest of their assets being impaired. So I suspect, based on the environment and the three factors I just mentioned, that a lot of owners of properties, of downtown office buildings, will be handing back the keys to the bank, which means the bank gets stuck with a loss, and I'll cover that. Anyway, this is an interesting view from a property owner, Patrick Carroll, being interviewed by Carl Quintanilla. Take a listen.
Joining us today, Carroll founder and CEO Patrick Carroll, whose company manages more than 33,000 multifamily units across 9 states. Patrick, great to have you. Those are big words. Talk about what needs to crack in order for us to get to that end point.
You know, and unfortunately, in this situation we're in, things have to bottom out, and they haven't bottomed out yet. I was just reading there's $1.5 trillion of debt maturing on commercial real estate by 2025. So sellers are not realizing how much their properties have lost value, and they're not willing to dump their properties yet because they haven't felt enough pain. They're about to start feeling pain. These lenders are spooked. There's no lending going on. There's no transactions going on. And it's going to be ugly. I mean, it's going to be at least as bad as 08, 09. People don't want to say that, but downturns always are worse than the one before, and upturns are always better. I've rode the wave of price appreciation, rent growth, things like that since 2011. Well, the party's over, unfortunately. It's going to be okay in multifamily, but the office market is going to be destroyed. You know, hotels are going to be destroyed. It's going to be ugly.
Yeah. Well, now you mentioned 08, 09, when we really were talking about residential exposure. It will be different in the respect now that you're really looking at CRE, right?
Yeah, but I mean, you know, when people start handing the keys back on their mortgages because they can't pay the interest on them, you know, you see your neighbor, you know, get his house foreclosed on. You see your neighbor sell for 20% less than you bought the property for. People start walking away from their houses. It happened, you know, 08, 09, you know, that was what caused the downturn. People thought the housing market was too big to fail. No one would ever bet against the housing market. Well, we saw people give their keys back. If you lose your job and you can't pay your mortgage, you're going to walk away, and especially if you're underwater.
So, Patrick, a lot of the focus right now, particularly in terms of some of the Wall Street notes and where regional banks, for example, are concerned, has been on office space and retail space, and this idea of a re-rating or need for those values and those prices to fall. The fact that you're in multifamily, are you seeing signs of weakness right now, whether it's renters or whether it's buyers of your units, or is this still a shoe to drop way far out? Like, what are you seeing?
Well, I talked to one of the biggest landlords in the world yesterday. He's a good friend. He's a mentor. And his phrase was, what he's telling everybody is stay alive till 25. Okay. So based off that, it feels like, you know, right now our fundamentals are great. People are paying rents. The market is healthy. What you have is a liquidity crisis. You have no transactions. There's no debt available. Cap rates have expanded over 5%. A year ago, they were at 3%. So if you do the math, that's almost 40% drop in value. No lender is willing to lend because they don't know where interest rates are going. And no one knows how to value these properties because no one knows where real estate, you know, valuations are ended up. It's all based on interest rates. Office is a double whammy. The fundamentals are terrible. After, you know, COVID, people work from home. The work week is now Tuesday to Thursday. Okay. And so people are taking less office space. No one wants to lend on it. It's a disaster. At least in multifamily, you know, the fundamentals are strong, and, you know, I think they'll continue to be strong.
Okay. So now you've got a view from a person who's got money in the game. He's a property owner. He's part of the equation. And now I'm going to look at an academic, a professor of finance and real estate at Columbia University. And so of all the people out there who are academics, CNBC chose to interview Sten von Neuberg, and a full professor at Columbia. What he points out is that this crisis, and he articulates the same crisis, puts two parties really at risk. Now, the owner can literally just walk away. They don't get the upside they had hoped for, but they also don't experience the downside. So they hand the keys back. Two parties are affected by this. One, he points out, are the cities. The cities derive a lot of revenue, tax revenue, from these downtown buildings. In some cases, up to 50% of their entire revenue for the city comes from these buildings. So if the value of the building drops in half, let's just say, what that means is that the cities, their ability to tax that building where it was is gone. So now they have to drop the value of the property to be in line with its current value and then tax that. So this is an impact to cities. So that impacts all of us. So if we go to a city, we want to go to a restaurant or shopping or whatever, even if you don't have a downtown office, we all need infrastructure. We need transportation. We need police and fire. We need streets, and building of streets, maintaining streets, etc. These are very, very large items, and oftentimes run into the billions. And so this impacts cities. The second thing it impacts, according to Van Nieuwenberg, is it impacts banks. So banks, now that starts to impact us. Not everyone, but if the banks are taking these losses, what it means is that banks become more conservative and they're less willing to lend to those who need money, for example, small business. So when we go to, downtown area, a lot of the downtown areas are small business, and a lot of those really small businesses that provide services and products to us are relying on a bank loan to finance either their capital structure or their operating capital. And so the losses coming from commercial real estate that hit those two areas impacts everyone. And he goes on to say it's not just the big cities, it's the small cities. And it's not just the US, it's everywhere in the world, because everyone is facing this same issue. So start to think about, we may not be in the commercial real estate business, but this starts to affect all of us. So take a listen to Stan von Nieuwenberg.
Professor, welcome. Good to have you with us. Let's have you explain quickly, if you would, what you mean by the urban doom loop. And it's not just commercial real estate or office buildings. It has a metastasizing effect throughout neighborhoods and communities.
Yeah, that's right. But the problem does start with the office demand, right? And we've seen with the advent of remote work and hybrid work a dramatic reduction in office demand over these past 3 years that has led to rising vacancy rates, and in fact to all-time high vacancy rates in the office market right now. And that does put downward pressure on the valuations of these offices. You mentioned that they're down, probably 20, 30% already. They're likely to fall by more. And that causes downward pressure on property tax revenues, because for a lot of cities, office tax revenues is a big chunk of their tax revenues, often as much as 50%. Some of that is coming from office, maybe 20%. So maybe 10% of overall tax revenues for cities comes from office. If those offices lose about half of their value, tax revenues fall, and that creates a huge hole in the budget. Now, the governments have, yes, go ahead.
So the transaction prices of office buildings has declined very markedly. Am I correct on that? And that's number one. And number two, is this a phenomenon that is affecting more the biggest of the big cities, the Washingtons, the LAs, the Chicagos, or is it more pronounced in, say, what I'll call the medium tier big cities, a Milwaukee, a Columbus? You know what I'm driving at.
Yeah, this is a national phenomenon. In fact, it's arguably an international phenomenon. But within the U.S., I think the cities that are most severely affected are the cities in the West, San Francisco, Seattle, but also medium-sized cities. Cities like Minneapolis, for example. Right? What these smaller cities, the problem that these smaller cities have is that often there's not a whole lot of other things that these cities have to offer in their downtown areas besides the commercial office district. And when that office district starts to falter, it sort of affects the entire city. Places like New York City, at least, sort of have more amenities, they have more culture, they have more restaurants, so they have other things to offer to their local population, and that sort of keeps them attractive, even in the wake of some of these rising vacancies.
What is the picture of the debt that office owners owe to lenders, and how soon is that debt coming due, and what is that likely to mean?
That's a tremendously important question. There's about, by lots of folks' calculations, about $600 billion of office debt that's potentially in trouble. A lot of that debt is sitting on banks' balance sheets. Banks have about a 60% of commercial real estate debt on their books. And for some banks, this is a material part of their book of business. And so to the extent that we see large declines in property values, some of that debt is going to get impaired and is going to have to be written down, and it will sort of erode the equity of some of these banks that are particularly exposed to commercial debt. So that could potentially be sort of an additional spillover mechanism, another doom loop, if you want, where these local banks that are now have less resources to make local business lending. You get a local credit crunch, and it sort of drags the local economy down further.
The third piece I'm going to play for you is from Chris Whalen. He is, I don't know who he is, but apparently he's a banking expert and a real estate expert. He follows them, reports on them, so forth. So he says the same thing, but as kind of an outsider, analyst, reporter person, he has a view which is a little different than the owner and a little different than the professor. But when I put all of them together, I come out with a composite view of what's going on with commercial real estate and how does this affect me and how does it affect you. So take a listen to Chris Whalen.
Forward Guidance is brought to you by Van Eck, a global leader in asset management since 1955. You'll be hearing more about a Van Eck ETF later on, but for now, let's get into today's interview. It's the morning of the 24th of January, and I'm joined by Chris Whalen, banking expert and founder of Whalen Global Advisors. Chris, great to see you.
Hey, good to see you. Nice to be here.
Chris, what's your current outlook on the state of the banking system in the U.S.?
Well, we just did a piece saying that the banks are slow walking commercial problems. And that's as it's always been. Banks have the capacity to manage credit in a way that funds cannot. And why? Because they have liquidity. So they can decide to keep certain situations alive, and in other cases, they'll liquidate them and foreclose. So what you're seeing with obviously office buildings, we all hear about that, but with other types of commercial property as well, warehouses, surprisingly, other types of commercial things like malls that we all know about, right? But in parts of the country that would surprise you, like Texas or Alabama, the Southeast is supposed to be, growth, right? But there are winners and losers in all of these markets. And as you build new, the old stuff goes down in value. It's just a basic rule of the game. And then in the legacy cities, it's a totally different situation. The use case changes due to COVID have rendered a lot of these buildings worth half of what they were before 2019. And I think people were already gravitating in that direction of changing lifestyle, changing work patterns because they could. The irony of, the industry I work with a lot, mortgages, is that they could send all of these people home while they were expanding headcount, by the way, 50% in 2020-21. Extraordinary. They didn't see some of these new employees for like a year. But the point is that now that these use cases have changed for buildings, the value changes. If the building's half empty and it can still pay its bills, okay, but that building has a net income that's far lower than it used to be. And by the way, investors have doubled their expectations for returns on assets like these. Cap rates have gone from 3 and 4 to 8. So that makes the hurdle even higher if you're the quote unquote owner of the building and you're coming up on the 7-year anniversary of your mortgage, and the banker looks at you and says, hey, Paul, you got to put money in if you want to keep this thing. So that's kind of where the industry is right now. There's a lot of noise. If you follow the commercial real estate press, like The Real Deal, which I really recommend, you can see what's going on, but it will take time for the banks to actually recognize and disclose these losses to investors. And that's why the analyst community really needs, I think, to start asking some questions in coming quarters. There was no discussion for US Bank on commercial real estate, which I thought was cute. I'm not worried about them. I know they can manage credit, but there are other banks out there that have serious problems. And remember, they're already working off of a balance sheet that's got unrealized losses because of the Fed. So the Fed hands the bankers a liquidity problem. It's a little better now because rates have rallied, but still they're down 5-10% on deposits. Those deposits are gone. And that's when banks fail, Paul. So that's kind of where the industry is. We were down in the fourth quarter sequentially on net income, a little bit of a credit build by some of the industry. And you'll see that slowly increase. I think they are getting ready for a credit event, whether it's just commercial. And I compare this to Texas in the 1970s, except it's commercial real estate in downtown locations. And then, the consumer will see, but it's not there yet.
Okay, now I'm going to shift gears to an interview. I'm going to go over to the stock market. So we've been in the world of commercial real estate and the effect on cities and banks and so forth. So now I'm going to shift to over into the stock market. So the person I'm going to play for you is Professor Jeremy Siegel. He's well known, and he teaches at the Wharton School. He's a professor of finance, and in the world of finance and professors, academics, I think Jeremy Siegel would be close to the top. So he gives his view. Now he's been in this, I don't know his age, but he's been around a long, long time. And he gives his view, and it's a very considered view. When I go back to 2022, so this is maybe about a year and a half ago, the market was declining quite a bit in 2022. As I recall, in the fall of 2022, I was researching this topic of what's going on in the market, and I saw an interview by Jeremy Siegel. I don't remember if I played it or not, I might have. And it was his view, which was that he believed, he was positive, and the market was declining. He said, now is a good time to invest in stocks. I'm positive on the market. As I look back at the approximate time he said that, he was right. No one was saying what he said. I wasn't even saying what he said. And so when I went back and listened to this, I thought, man, this guy, amidst all of the negativity, he got it right. And if you're an investor and you follow Jeremy Siegel, you would have been mostly right. And in 2023, he stayed positive for the entire year. How many did that? How many, individual investors, institutional investors? Well, I don't know how many, but I would tell you that he stayed invested, and I know from talking to a lot of people, they were not invested in all of 2023. They were kind of reacting to the decline of 2022. But he stayed invested and said that's why, and he gave his rationale for it. Bottom line, he was right. So that's why I'm going to play him, because and I don't know further back, I've not tracked him that far back, but I would say he did get it right during that period when a lot of people did not get it right. And he is expecting, he says this, about an 8 to 10% growth in equities this year. So, but I've played other pieces, and people typically say, yeah, it's going to be probably a positive year, but it's going to be a rough ride. So he doesn't address that. He just says it's probably going to be 8 to 10% growth. But he basically has an optimistic view. So I wanted to play this for you. So if you have an optimistic view, or you're looking for kind of a person who doesn't have a dog in the fight, I think this might be helpful for you. So take a listen to Professor Jeremy Siegel.
It takes us right to our talk of the tape. What stocks are likely to do in the weeks ahead and how the next 5 days will be critical to that outcome. Let's ask Wharton Professor of Finance, Jeremy Siegel. You see him there as he joins us now. Professor, welcome back.
Happy to be here, Scott.
I'm so happy to have you with us today because we do have so much important lying ahead. The state of the market today to you is what?
I'm still positive on the market. We are selling for 20 times earnings, although, I mean, if you're a growth stock, you're selling at 25 to 30. If you're a value stock, you're selling at 15, 14. So there is a difference. Overall, 20 is okay. It's not cheap. And I still think we can get 8 to 10% for the year. The economy is still very strong. I think we're actually going to beat 242 earnings on the S&P 500. As a result, I think stocks could advance.
I agree with Professor Siegel. I think he's right. I think we're probably going to end up in a positive view this year. I don't know for sure, but that's my personal opinion. And 8 to 10%, perhaps that's correct. Another view is Peter Bookvar, and he runs an investment firm, and I like his view as well. These two views, I want you to think of this, it's just my opinion. These two views are different, but they're not inconsistent. So it's entirely possible that both of them are correct. He makes a point, which I think is interesting, that we are getting mixed signals from the market. Some indicators are saying positive, some are saying negative, and some of them contradict each other. So when you look at all of the indicators, let's just say they're fundamental indicators, when you look at those, it is easy to draw one conclusion or another. And if you have a bias or prefer a particular bias, you may look at them and say, he's right on what I'm thinking, but you may be ignoring some of the other things that contradict that. Or if you look at him and consider everything he's saying, you walk away and go, I'm confused. I don't know what to do. So he points out these inconsistencies and contradictions. And it makes it hard to predict what's coming next. So if you're an optimistic person, you may want to invest because he'll give you some material for that, and vice versa. But it's a very good analysis of the market, and then he brings the actions of the Fed and the thinking of the Fed into the equation. So it's a very good, I thought, a balanced view. It's, he has a particular bias, I'm sure, but it seems to be a good analysis. So take a listen to Peter Bookvar.
Peter Bookvar is Chief Investment Officer at Bleakley Financial Group and a CNBC contributor. Peter, great to have you with us. Bonawyn just said he is begrudgingly putting money into the markets. That was his motto in Q4 as well. Are you ultimately, I understand that you think the economic data is going to turn and work against the markets, et cetera, but at this point in time, do you acknowledge that the market seems a little bit stronger than what you may have anticipated going into this year?
Yeah, well, certainly the last couple of days and how we ended last year. But I understand the market's desire to rally on expectations of Fed rate cuts. I mean, that's been the playbook for decades now. So I get why we rallied. I think earnings over the next couple of weeks are just in time in the sense of testing the thesis that everything is fine. And there are just so many mixed signals within the global economy that it just can make your head spin. When you look at holiday sales, for example, you have the MasterCard spending pulse, you have the National Retail Federation saying that holiday sales were about 3.5%. Well, that's the rate of inflation. So on a real basis, holiday sales were zero. U.S. manufacturing, global manufacturing for that matter, are in a recession. You have the pace of existing home sales near 30-year lows, but home building doing okay. You have high-end spending on travel and leisure, hospitality, restaurants doing fine, but spending on stuff not doing well. And if you looked at the Beige Book last week, of the 12 districts, 8 basically saw no growth. You had 3 that saw modest growth. one that saw a modest decline. That doesn't sound like a great economy. So and then you look at overseas, Europe is essentially at best flatlining. China, we know, is further decelerating. So it's really a tough environment to both figure out and maneuver through. And I think the stock market is really trading off. The Fed is going to not be in our face anymore, and maybe even in QT2 to throw that in there, and just buy stocks because of that, rather than a real analysis on the full macro.
So, Peter, when you would admit that the market is taking its lead from the Fed, if the Fed cuts, the market's going to rally. That's been the standard. What can QT give us a clue on right now? Should we watch for that to stop first, and then the cut is coming? Because you can't have both at the same time, I wouldn't think.
Well, I think that's an internal debate within the Fed. Can they continue with QT because Jay Powell wants to get the balance sheet to a level that he's comfortable with, which he can't even define, actually, but at the same time sort of tweak monetary policy on the rate side to reduce the odds of a recession, but not cut too much that you stoke higher inflation again. And this is a very difficult situation that Powell's in. I think his main priority right now is not to stoke a flare-up in inflation. He thinks he's got a handle on it with the downside of the cyclical spike, but keeping inflation low is his next battle. And I think it's really going to be interesting to see how the Fed plays the balance sheet with what they do with interest rates. But even the interest rate story is a trade-off. If they only cut a couple of times, call that maybe just a tweak, and the Fed funds rate's still going to remain high. If they cut 6 times, 7 times, that's because the unemployment rate's going to 4.5 to 5, and we're in a recession. So this is not an easy situation to really analyze, and from the Fed's perspective, to actually maneuver through.
Okay, thank you for watching. If you have questions or comments, leave them in the comment section below.